For years, Cyprus had a simple reputation among founders. EU jurisdiction, English-speaking business environment, relatively low corporate tax, and a familiar setup for international companies. But in 2026, the Cyprus story is more nuanced. The old headline, 12.5% corporate tax, is no longer the full picture. Cyprus in corporate tax is moving to 15%. So the real question is not, is Cyprus cheap? The real question is, when does Cyprus actually make sense for an IT company? And what do founders need to get right before they register?
Cyprus remains attractive because it sits at the intersection of several founder priorities. It is an EU member state. It has a business system familiar to international investors. English is widely used in corporate, legal, and accounting practice. It is popular among founders, holding structures, software companies, consultants, IP-driven businesses, and remote teams. But the main reason Cyprus keeps appearing in founder conversations is that it can combine company registration, tax residency planning, access to EU legal infrastructure, and personal relocation options in one jurisdiction. For IT founders, the standard route is usually a Cyprus private limited company. This is the familiar corporate vehicle used for software development, SaaS consulting, holding shares, managing IP, contracting with international clients, and building an operating business with an EU legal presence. At the basic level, the company needs at least one director, one secretary, and a registered office in Cyprus. So even before tax planning begins, Cyprus is not just buy a company online and forget about it. There is a real corporate maintenance layer. The registration process usually follows a predictable sequence. First, the company name is checked and approved. Then the constitutional documents are prepared. Directors, secretary, shareholders, and registered office are appointed. The company is filed with the registrar. After incorporation, the founder moves to the operational layer: tax registration, accounting setup, beneficial ownership filing, bank onboarding, and internal company records. This is where many founders make the first mistake. They treat incorporation as the finish line. But in Cyprus, incorporation is only the beginning.
The most important update for 2026 is corporate tax. Cyprus was widely known for its 12.5% corporate tax rate, but the rate is moving to 15%. For founders, this changes the way Cyprus should be presented. Cyprus is still competitive, but the selling point is no longer just one of the lowest corporate tax rates in Europe. The stronger point is structure. Cyprus can still be attractive if the company has the right business model, the right founder profile, real management logic, proper reporting, and a clear tax position.
A Cyprus company and a Cyprus tax resident founder are two different things. This matters because many founders do not only want to register a company, they also want to understand whether Cyprus can work for them personally. Cyprus has a well-known 183-day route and a 60-day tax residency route. Then there is the non-domicile regime, which may be very attractive for founders receiving dividends. But the key is not the headline. The key is whether the founder genuinely fits the conditions. Cyprus is not useful if the company is just a paper entity with no real logic. This is especially important for IT businesses. If your company signs contracts, owns IP, receives revenue, pays contractors, invoices clients, and distributes profits, then the question becomes, where is the company actually managed? Who makes decisions? Where are board meetings held? Where is accounting maintained? Who controls contracts and bank accounts? Where is the founder tax resident? Where are employees or contractors located? Where is the intellectual property developed and exploited? Substance does not always mean a large office and dozens of employees, but it does mean the structure should match the economic reality. On paper, the corporate setup is not complicated. A private Cyprus company needs at least one director. It needs a secretary and it needs a registered office in Cyprus. But founders should not treat these as cosmetic appointments. The director is not just a name on a document. The registered office is not just an address for decoration. The secretary is not just an administrative detail. These elements affect governance and filings, notices with the record keeping, and the practical credibility of the company. Cyprus is not a register and disappear jurisdiction. Companies have annual compliance obligations. They need accounting as much as they need corporate records. They also usually need financial statements and tax filings. And the company information must always be updated with the registrar. One useful update: the old annual company levy was abolished from 2024 onwards. So the cost structure changed, but compliance did not disappear. For IT companies, Cyprus is usually considered for several reasons. First, international contracting. A Cyprus company can be a familiar EU counterparty for clients, vendors, and partners. Second, shareholder and holding logic. Cyprus is often considered for founders who need a clean corporate structure for international ownership, investment, or future exits. Third, relocation. If the founder is also considering personal tax residency in Cyprus, the company and personal structure can be planned together. Fourth, operational simplicity compared with larger, more expensive jurisdictions. Cyprus is not the right answer for every IT company. If all clients, employees, management, and personal life are in another country, a Cyprus company may not solve the tax problem. If the founder cannot maintain a defensible tax residency position, the personal planning may fail. If the company has no real management logic in Cyprus, substance questions may arise, and if the founder only wants low tax without reporting, accounting, or proper documentation, Cyprus is the wrong jurisdiction. In 2026, the serious question is not where the tax rate is lowest. The serious question is where the structure can survive review. Before registering an IT company in Cyprus, founders should answer 5 questions. 1. What will the company actually do? Software development, SaaS, consulting, agency work, or maybe investment activity. 2. Where will the founder be personally tax resident? 3. Who will manage the company, and where will key decisions be made? 4. What reporting will be required? Accounting, tax returns, annual return, beneficial ownership updates, and financial statements. 5. How will the company open and maintain banking or EMI access? These questions determine whether Cyprus is a strong structure or just another company that looks good on paper.
This is where Icon.Partners can help. For founders, the challenge is rarely just register a company in Cyprus. The real task is to connect the company, the founder's personal tax position, the director and substance setup, reporting calendar, banking route, and a long-term business plan. At Icon.Partners, we help structure this process, choosing whether Cyprus is the right jurisdiction, coordinating company registration, preparing the compliance logic, assisting with EU-based banking and EMI options, and making sure the founder understands what must happen after incorporation. No magic tax promises, no offshore cliches. Just a properly structured EU company setup for founders who want to operate cleanly. So, should you register an IT company in Cyprus in 2026? Maybe. Cyprus still has strong advantages for IT founders: EU status, business infrastructure, international familiarity, useful personal tax planning options, and a practical corporate system. But the old simple story is gone. It is not just 12% tax. It is not just open a company and invoice clients. And it is definitely not a no reporting jurisdiction. In 2026, Cyprus works best when the structure is real. The founder's tax position is clear, the company has proper management, substance is defensible, reporting is handled, and the business model actually fits the jurisdiction. That is the difference between registering a company and building a structure that can support the business.